It's the end of the day with Ray. Hello, my friends. Well, folks, today we're going to jump in that gigantic, sharp, interactive board. I want to share my thoughts regarding Xerox's second quarter. Xerox halfway through their FY2025. Xerox made a big announcement the other day. I did an episode on it, but they got together with Kyocera. They said, hey, Kyocera, we'll sell your inkjet production machine. I suggested that Xerox call that thing the Xerox ProJet C. I really like that name. I even told them they could put a big red swoosh on it. That looks kind of cool. We'll see what Xerox does with the naming of the machine. But you know, Xerox bought a couple interesting companies. They bought a company called IT Savvy. They bought a company called Lexmark. I want to start out today's episode by just talking about those two companies really quick. IT Savvy was a $400 million IT services company, very successful in its own right. When Xerox wanted to have a foundation to deliver managed services into the marketplace, they wanted to make sure that foundation was solid. IT Savvy was a strong, solid company. When Xerox got together with IT Savvy, Xerox didn't buy someone's IT services hobby. Xerox bought an IT services business. And that's one of the reasons that Xerox is sharing the numbers from their services business on their financials for the whole world. Because, folks, I'm telling you right now, when you look at some of these other OEMs, and they can talk about IT services all they want, but they hide the numbers, they bury them in with the print. It's hard to even know what they're doing or if they're growing, and they just hope it all works out. That's a hobby. That's a hobby. When I think about Lexmark, you know, Xerox bought the future of business print. We all know there's more A4s going in the marketplace than A3s. I mean, everybody knows that, right? And so if you're going to figure out a strategy to capitalize on where all the business print's going, well, you have an opportunity to buy a major player in the space where it's all going. Why wouldn't you buy them? I mean, I kept yelling at my other OEM friends, why didn't you go buy a Lexmark? They all should have. Lexmark should have had so many suitors, it was crazy. But Xerox ended up getting them. And folks, you know, these are two acquisitions that are based on a reinvention strategy. And I mean, we got to have an IT services foundation that's actually makes some sense for us to go into the marketplace. We're not going to go out and buy some $10 or $15 million IT services company and inject that into a billion-dollar, multi-billion-dollar business and say, go for it. We need a company that's got the ability to grow to $1 billion themselves in realistic terms. And folks, you know, I got to tell you, when you look at the combined pro forma of these for the last trailing 12 months. I mean, you take Xerox, Lexmark, and IT Savvy, that's $8.6 billion in 2024 revenues. So this is going to really help Xerox increase that top line. And with their synergies they'll pull out of this, it'll help increase their bottom line as well. But again, it's two strategies based on a reinvention strategy. You know, do they have a lot of work? Hell yeah. They got a whole lot of work to do to make all this work and to make it work exceptionally well. There's no doubt about it. But reinventions, like I say, you can't just turn a damn light switch on. Let's look at the numbers. If you compare the first half of FY 2025 to the first half of FY 2024, Xerox revenue is down 1.5%. Keep in mind that in that first quarter of 2024, second quarter of 2024, we weren't doing a whole lot of things with IT Savvy, right? We weren't doing anything with Lexmark. In the second quarter of 2025, we really weren't doing anything with Lexmark. That thing just started July 1, right? So we're going to start seeing these numbers change. We're going to start seeing them beat their top line revenue. But again, that beating of the top line revenue was because they went out and acquired things. So we don't want to necessarily grow because we acquire things, but when we're in a declining marketplace, our core deliverable is print. We better figure out how we're going to grow those revenues outside of the norm. Again, let's buy print where print's going and invest in Lexmark. You know, let's build us a nice foundation in IT so we can build out our services business. But their total revenue for the first half of 2025 is $3.033 billion. They had a 2.7% operating profit. If you blend first quarter, second quarter together, it doesn't really matter. You know, this quarter over quarter nonsense I could care less about, especially when so much changes, you know, from last year to this year, which in Xerox's case, a lot's changed. Do they need to increase that operating profit? Hell yes, they do. They know that. And folks, at the end of the day, they have a history of performing an operating profit. You know, 2.7% is not their norm. You know, like some of these other OEMs out there, if they get 3%, they all have parties. You know, Xerox has not been an operating deficiency company, let's just put it that way. They understand the importance of it, and they've had a nice track record with their operating profit. Let's break it apart a little bit. If you look at the print and other segments, for the first half of the year, it's $2,660 million, has $106 million profit, operating profit, so that's a 4% margin. So they got a 4% operating profit margin on their first half in that printing business. Again, it'd be nice if it was 8, 9, right? Going through a reinvention, you know. Folks, they're not going to get a free pass for getting yelled at by the end of the day with Ray for too long. They got to get that up there. They know that, right? Let's look at this IT solutions revenue. First half of FY 2025. Total revenue for the IT services segment is $377 million for the first half. And if you look at this split, they got products at $258 million, services at $115 million, of course, intersegment at $4 million. But when you think about the percentage of the $377 million and what's that going to products and what's that going to services, so 68% of the IT solutions segment, if you will, is products. 31% is services. You got about 1% intersegment. But folks, you know, here's the reality. And this is where even the end of the day with Ray sometimes has to recalibrate his thinking based on what's going on in the marketplace. When I look at IT services being delivered from a mega dealer or even from a smaller dealer, I don't think you should be running around selling a whole bunch of products, doing a lot of work for customers that aren't under contract with you. When I think about a Xerox, a global company, they could sell hundreds of millions of dollars worth of products in their MIF. And they should be able to do that. They should do that because they can scale that. It won't be very profitable for them. That'll drag down the profitability because compute products are not profitable going into end user's office. You need the services on those. So we'll see how that goes. But right now, their services business is being at 31%, you know, $115 million over the last, you know, 2 quarters. Nothing to sneeze at. But at the end of the day, here's the problem. Because when you have services as a low percentage of your revenue, that's where all the profit is. You know, the gross profit on services should be like 60%. And you can see that the gross profit for Xerox's, you know, IT solutions business is about 16.5%. And that is being lowered by the products piece. 68% of the revenue coming from products at a less margin. As they grow that services business, as they get more and more sophisticated accounts, upstream accounts, you'll see the gross profit margin increase. But it'll never be a 60% just because of the sheer scope of what they could deliver around the product side. So this IT business at Xerox is going to be really, really interesting to watch, and I'm so excited that they're actually showing their numbers. They're not afraid to tell the world what they're doing, okay? Which is important, because I believe if you don't measure this stuff, you know, where everybody knows how you're measuring it, it becomes kind of silly. As I think about Konica Minolta, I think about Ricoh, and now we got Canon trying to get into the IT services business. You're going to lump it all together and hope no one pays attention to it. You know, when you don't pay attention to something by the numbers, you know what that means? That means you got a hobby inside a business. That's just a hobby. Hope it works out. It's not a hobby over there at Xerox. The IT solutions key performance indicators, their pro forma gross billings grew by 8% year over year, so they are growing that thing. They got strong orders and print cross-sale activity. You know, I mean, if you think about it, if this IT savvy business, if you will, got like 3% of Xerox's MIF, okay, just 3%, that thing would be a multi-billion-dollar IT services company. Because we all know that there's a lot more money being spent on IT services and software solutions in businesses than print, right? I mean, you all remember that. I talk about that a lot, right? Come on. I wanted to look at their capital structure. You know, a lot of people out there screaming, oh, Xerox has all this debt, they're going to go bankrupt, blah, blah, blah. You know, look, at the end of the day, they do have some debt, but you got to understand they got $1.6 billion debt is financing allocated debt. We all know they're doing the deal where they're dumping off some of that financing business over to Peak Solutions. I think DLL picked some up in Europe. But at the end of the day, that's not bad debt because it's spread over a whole bunch of customers. But when you look at their net core debt, it's $2.4 billion. If you look at their net core debt to the last 12 months, trailing EBITDA, we're at 3.0 times. It should be between 1 and 3. 3 is kind of like the bad, right? It's got to get lower. But they just bought Lexmark. They just bought IT Savvy. So they do have to bring in some synergies. They got to bring in some cost savings. They got to increase that EBITDA. They got to grow the top line revenues. And this will all balance out. But to think that they were going to do all this without assuming any debt is just insanity. That's just not reality. And the question is, how good will they be at paying down this debt? You know, how good will they be at cutting costs where they need to cut them? Because they have to do that. But folks, it all really has to do with their operating profit. If you're a company that's undisciplined in operating profit and, you know, don't run out and get a bunch of debt. But Xerox has been disciplined with their operating profit. They've had hiccups just like everybody else, but when you compare them quarter after quarter, year after year, they literally crushed both Ricoh and Konica. Let's just say that. That's the reality. They crush them. They have discipline. You know, are they the best at operating profit? No. But keep in mind, they also are the major player delivering print equipment into offices all over the world, and we all know what's going on with print equipment. People are using it less, right? So they've had a lot of pressures, let alone, you know, trying to reinvent a 100-year-old company, get rid of an activist investor. There's a lot of things they've had to do. But at the end of the day, I think we could bet on their discipline. I think we could bet on their intellect because they do have both over there at Xerox. You know, folks, they have to do their cost cutting. And I've been thinking about this a lot. And Xerox is on target to get these cost synergies back. You know, they want to get up to $250 million. And you know, increased EBIT, if you will, by the year 2027. And I think there's going to be a whole lot of cost savings around AI that we're not even paying attention to at this point because we don't know. But AI is going to change the game in so many ways, especially around cost. And it's going to be tough because a lot of that's going to have to do with human capital. You know, we won't need to spend a lot of money on human capital. This AI will do it this way, so we're going to have to, you know, go through the world adjusting to that. But it is a reality. And I do believe that if they got rid of that damn manufacturing component over there at Lexmark, they could leverage that somehow, and maybe they could actually get some pretty good money out of that thing. Because I really don't want Xerox to be a manufacturer. I've been very clear about that. And folks, at the end of the day, I don't care if I like the OEM or like the partner or not. If they're doing something I wish they weren't going to do, I am not afraid to say they shouldn't do it. And I wish the hell they wouldn't be a manufacturer. And I think they could do something with that. We'll see what time tells. I mean, they can't come out. I mean, our industry's so impatient. You know, our industry can't imagine anything that's not in front of them. So a lot of times, these organizations, I guess they really can't tell you everything they're going to do because people would just freak out. So I'm hoping that's what that is. There is no light switch which turns on plans into reinvention. I mean, you just can't turn your reinvention plans into reality and success by turning on a light switch. It takes damn hard work. Strategy for reinvention takes boldness and intellect. And I want us all to think about the players in the marketplace. You know, and that's why I've challenged all of you after I did that episode when I went to that BTA meeting. You need to listen to the leaders at Xerox. And then you need to listen to some of your other OEM friends. And I look, some of these folks I'm very close to. I like them. But what are we talking about? Are we talking about dragging the past to the future? Or are we talking about delivering the future to the present? I don't ever hear the leadership at Xerox talking about dragging anything from the past to the future. And even the past that they're dealing with, that they invested in, it's really about the future of the past when I'm talking about their A4 strategy around Lexmark. So it does take boldness, it does take leadership, and there are a couple of things that they got to do pretty quickly. And they need to figure out their production space. It's fantastic that they did this deal with Kyocera. Everybody's excited about that. But we need more. I really want them to do a deal with Rizzo and bring that Valisys back into the picture too, because I think that Valisys has a place in the marketplace. And I also believe the Kyocera product has a place in the marketplace, no matter whose name's on it. But there needs to be more in that production space. And this is where I believe Xerox could really leverage that Lexmark manufacturing to maybe go and find a manufacturer that can help them really deep into that production space, if you will. A lot of things to think about, my friends, but one thing's for sure. Status quo is the killer of all that'll be invented. Don't get stuck there, and I'll see you all tomorrow.